What happens to the US economy if giants like NVIDIA and Apple suddenly go to zero? Sounds dramatic, right? Stick around, subscribe to Money Demystified, and comment your retirement age. Because by the end, you might seriously reconsider that number. Do a quick Google search. It's not hard to find headlines showing record-breaking market values for the biggest companies in the US stock market. But have you ever felt like those headlines don't match the reality of everyday life? So, what's really going on? How do they impact the US economy? With that in mind, let's explore what would happen to the economy if the 9 largest companies by market value suddenly dropped to zero. Let's check out the market caps of the top 9 as of April 2026. As shown in the chart, major tech giants currently dominate a significant portion of the US stock market. Companies like NVIDIA and Apple together account for nearly $22 trillion in combined market cap. If these 9 companies were a country, they'd have the second largest market cap in the world, or about 40% of the entire US market. For context, the European market is valued at $18.7 trillion, while China's stands at $12.1 trillion. Now let's look at this like economists pretending to understand reality. On one side, a fictional country made of 9 companies worth $22 trillion. On the other, the United States itself. Same planet, same currency, wildly different structures. And that table you're seeing? It's where things start getting uncomfortable. $22 trillion in market value sounds like a global superpower. But right next to it sits the US economy at $55 trillion in total market value. For GDP, this country of companies generates about $2.6 trillion in economic output. Respectable, impressive even. But the United States produces around $30 trillion. GDP per capita for this corporate nation is about $900,000. Meanwhile, the US sits around $85,000. It sounds like everyone in techland is a genius billionaire. Spoiler alert, that's not how this works. That absurdly high productivity number isn't magic, it's math distortion. When a small workforce generates massive revenue through automation, software, and global scale, the output per worker explodes. It's less about human productivity and more about leverage. Technology doing the heavy lifting while humans take the credit. Now look at workforce size. This entire country employs about 2.8 million people. Sounds big until you compare it to the United States, where roughly 160 million people are working. That means this corporate empire represents just a tiny slice of the labor force, despite its overwhelming financial presence. Put differently, these companies hold massive economic power while employing only about 1.25% of the workforce. That's not a typo. 1.25%. It's like having a handful of people controlling the engine of a massive ship while the rest of the crew keeps the lights on. This creates a fascinating imbalance. Enormous value concentration, minimal labor footprint. These companies don't need millions of workers to dominate markets. They rely on code, infrastructure, and scale. Which sounds efficient, until you realize how disconnected that efficiency is from the broader economy most people live in. So what we're really seeing is not a traditional economy, but a high-performance machine. One that extracts value globally, operates digitally, and scales infinitely without scaling employment at the same rate. It's not a country, it's a system optimized for output, not distribution. And that distinction matters more than it seems. Because real economies depend on people earning, spending, and circulating money. This corporate nation generates enormous revenue, but it doesn't distribute opportunity in the same proportion. It concentrates it. And concentration, historically, tends to come with consequences. Think about it this way. If this were a real country, it would have incredible wealth but very few jobs relative to its size. A place where productivity is sky-high, but participation is limited. Economists would call that unstable. Markets, however, call it efficient. Until something breaks. Another layer to this comparison is how these companies generate value. Unlike traditional economies that rely on manufacturing, agriculture, and services across millions of participants, these firms monetize platforms, data, and intellectual property. Their output scales globally, but their workforce doesn't need to follow that same trajectory. That's why comparing them to a country feels both accurate and misleading at the same time. Financially, they resemble nations. Structurally, they behave nothing like one. And that gap, between appearance and reality, is exactly where systemic risk begins to hide. Because if a traditional economy shrinks, the impact spreads gradually across sectors. But when value is concentrated in a few entities like this, any disruption doesn't ripple, it shocks. The system doesn't bend. It jerks violently. And that's the part investors tend to underestimate. So this table isn't just a comparison. It's a warning disguised as a statistic. A reminder that massive valuation doesn't equal economic balance. And more importantly, it sets up the real question. If this country looks powerful but isn't structurally stable, what happens if it suddenly disappears? Let's start the projection. Now let's address the number everyone loves to quote at dinner parties, $22 trillion. It sounds like a vault filled with cash, gold bars, and possibly a dragon. But market value isn't money sitting somewhere. It's a constantly changing estimate based on what investors think these companies are worth. Market capitalization is essentially a mood ring for investors. It multiplies share price by the number of shares outstanding. If people feel optimistic, the number goes up. If they panic, it drops. No factories disappear instantly, no offices vanish, just perception shifting at scale, like a financial hallucination shared by millions. That's why this 22 trillion can shrink faster than most people expect. It's not locked, it's not guaranteed, and it's definitely not sitting in a bank account waiting to be withdrawn. It's value that exists only as long as confidence exists, and confidence, historically, has a very short attention span. Compare that to GDP, which measures actual production, goods made, services delivered, real economic activity. GDP is slower, heavier, harder to fake. Market cap, on the other hand, can swing wildly based on future expectations. One is grounded in reality. The other is heavily influenced by belief about the future. And investors don't just buy what exists, they buy what they hope will exist. Especially in technology. Artificial intelligence, cloud computing, electric vehicles, these are not just industries, they're narratives. And narratives, when strong enough, can inflate valuations far beyond current earnings or tangible output. This is where things get subtly dangerous. When a large portion of the market is priced based on expectations, any shift in those expectations can trigger massive revaluations. Not because the companies stopped functioning, but because the story investors were telling themselves suddenly changes direction. Think about how fragile that is. If growth slows slightly, if regulation tightens, or if a new technology disrupts the current leaders, the entire valuation framework starts to wobble. And since these companies dominate such a large share of the market, their wobble becomes everyone's problem. Another misconception is assuming that if these companies lost value, that money would simply go somewhere else. In reality, much of it would just disappear. Market losses don't transfer neatly, they evaporate. Wealth isn't redistributed automatically, it's often just erased from balance sheets and portfolios. This becomes especially relevant when you consider how many retirement funds, pensions, and index funds are heavily invested in these giants. When their valuations drop, it's not just abstract numbers changing. It's real people seeing their future purchasing power shrink, often without warning. And because these companies are so heavily weighted in major indices like the S&P 500, their valuations don't just reflect the market, they shape it. When they rise, they pull the index up. When they fall, they drag everything down with them, regardless of how other sectors are performing. So the illusion of diversification starts to break. Many investors believe they are spread across hundreds of companies through index funds. But in reality, a significant portion of their exposure is concentrated in a handful of tech giants. It's diversification in appearance, not in substance. This concentration amplifies volatility. A single earnings miss, a regulatory headline, or a shift in investor sentiment toward one major company can ripple through the entire market. It's no longer about isolated risk, it's systemic, embedded into the structure of modern investing. And here's the paradox. These companies are incredibly strong operationally. High margins, global reach, dominant platforms. Yet their market valuations still rely heavily on future growth assumptions. Strength doesn't eliminate risk, it just changes the type of risk investors are exposed to. So when we say $22 trillion, we're not talking about a static pile of wealth. We're talking about a dynamic, fragile construct built on expectations, projections, and collective belief. It's powerful, yes, but also inherently unstable if those beliefs start to shift. Which leads to a critical realization. If this value can expand rapidly during optimism, it can contract just as quickly during fear. And when that contraction happens at this scale, it doesn't just affect investors, it sends shockwaves through the entire financial system. Now imagine that shift doesn't happen gradually, but all at once. Not a slow correction, not a bad quarter, just a sudden collapse in confidence. The kind where investors don't ask questions first, they hit sell. That's when valuation stops being theoretical and starts becoming a real, measurable shock. If these companies were to go to zero, the immediate effect wouldn't be subtle. It would be violent. Trillions in market value would vanish almost instantly, wiping out a massive portion of the S&P 500. This isn't a dip. This is the kind of drop that rewrites financial history in real time. Index funds would be among the first to feel it. Because they automatically track the market, they can't escape that. When the largest components collapse, the entire index follows. Millions of investors, many of whom believe they're playing it safe, would suddenly realize how concentrated their risk actually was. Pension funds wouldn't be spared either. These institutions rely heavily on large-cap equities to generate long-term returns. A collapse of this magnitude would punch a hole in retirement systems, forcing difficult decisions, higher contributions, reduced benefits, or both. And those consequences don't stay in spreadsheets, they reach households. Then comes the cascade effect. As portfolios lose value, investors begin selling other assets to cover losses or reduce risk. That selling pressure spreads into sectors that had nothing to do with the original collapse. What started as a tech crisis quickly becomes a full market liquidation event. Liquidity, the invisible oil that keeps markets running smoothly, begins to dry up. Buyers step back, spreads widen, and prices become more volatile. In extreme scenarios, markets can temporarily freeze, not because assets have no value, but because no one is willing to agree on what that value should be. Banks and financial institutions would also feel the pressure. While they may not hold these stocks directly in massive amounts, they are deeply interconnected through lending, derivatives, and collateral. Falling asset prices can trigger margin calls, forcing more selling and amplifying the downward spiral. And then there's psychology, the most underestimated force in finance. Fear spreads faster than data. Once investors see massive losses, behavior changes instantly. Risk tolerance disappears, long-term strategies get abandoned, and the focus shifts from growth to survival. Markets don't just reflect fear, they accelerate it. At this point, central banks would likely step in. Emergency measures, liquidity injections, possibly even interest rate cuts. The goal would be to stabilize markets and restore confidence. But here's the problem. You can inject liquidity, but you can't instantly rebuild trust once it's broken. Governments might also consider intervention, especially if the collapse threatens broader economic stability. Regulatory responses, investigations, policy changes, all would come into play. But these actions tend to be reactive, not preventive, meaning they arrive after significant damage has already been done. Meanwhile, global markets wouldn't sit quietly. U.S. equities are deeply integrated into the global financial system. A collapse of this magnitude would ripple across Europe, Asia, and emerging markets. International investors would face losses, and global capital flows would become unstable almost overnight. Currencies could also react. As confidence in U.S. markets declines, demand for the dollar might fluctuate unpredictably. Safe haven assets like gold or government bonds could see sudden inflows, while riskier assets get abandoned. The financial system begins to reprice risk across the board. And remember, This is all happening before we even touch the real economy. At this stage, we're still dealing with financial markets, stocks, funds, institutions. But financial shocks don't stay contained. They eventually spill over into hiring decisions, business investments, and consumer behavior. Because when wealth evaporates, spending tends to follow. Households feel poorer, even if their income hasn't changed. Companies become cautious, delaying expansion or cutting costs. The feedback loop begins. Lower spending leads to slower growth, which leads to more uncertainty, and the cycle continues. So what starts as a collapse in market value quickly evolves into something much larger. It becomes a systemic event, one that challenges not just portfolios, but the stability of the entire economic framework built around these companies. And that's when the real consequences begin to unfold. Now we leave Wall Street and enter something far more sensitive, the real economy. Because while markets react in seconds, real life reacts in weeks, months, sometimes years. And when companies this large disappear, the consequences don't stay on screens, they show up in jobs, prices, and daily routines. Let's start with employment. Directly, these companies account for roughly 2 to 3 million jobs. In a country with around 160 million workers, that might not sound catastrophic at first. But that number is only the visible layer of a much larger, deeply interconnected employment ecosystem. Behind those direct jobs sits a massive network of indirect employment: suppliers, logistics partners, contractors, developers, advertisers, and small businesses built entirely around these platforms. When the core disappears, the surrounding ecosystem doesn't slowly adjust. It contracts abruptly, often without time to adapt. Take Amazon out of the equation, and it's not just one company disappearing. It's a large portion of US e-commerce infrastructure: warehousing, delivery networks, third-party sellers, cloud services through AWS. Entire business models depend on its existence. Remove it, and thousands of companies lose their operational backbone overnight. Now remove Alphabet and Meta, and suddenly the digital advertising world loses its primary engines. Businesses that rely on targeted ads to acquire customers are left in the dark. Marketing becomes less efficient, more expensive, and far less predictable. Growth slows, not because demand disappears, but because visibility does. Then there's Apple. It's not just a hardware company, it's an ecosystem. App developers, accessory manufacturers, service providers, all tied to its platform. Without it, millions of small revenue streams vanish simultaneously. It's like removing a central nervous system and expecting the limbs to keep functioning normally. Tesla's disappearance would ripple through the electric vehicle sector, not just in production but in perception. Investor confidence in EVs, battery technology, and clean energy innovation would take a hit. Suppliers and competitors alike would feel the shock, as the narrative driving the industry suddenly weakens. And NVIDIA. Remove it, and you're not just losing a chip company, you're disrupting the foundation of modern AI infrastructure. Data centers, machine learning development, cloud computing capabilities, all rely heavily on its technology. Progress in multiple industries would slow, not because of lack of ideas, but lack of tools. What makes this particularly disruptive is how embedded these companies are in everyday life. People don't just work for them, they rely on them. Shopping, communication, entertainment, navigation, even basic business operations. Their absence wouldn't feel like a corporate event. It would feel like a systems failure. Small businesses would be among the hardest hit. Many rely on these platforms for sales, marketing, payments, or logistics. Without them, they lose access to customers, tools, and infrastructure. For some, it wouldn't be a matter of adapting, it would be a matter of survival. Consumers would notice changes quickly. Fewer options, higher prices, slower services. Convenience, something often taken for granted, would decline. And when convenience drops, efficiency drops with it. That affects productivity, and productivity is one of the key drivers of economic growth. Larger corporations wouldn't be immune either. Many depend on cloud services, advertising platforms, or supply chains connected to these giants. Disruptions at this level force companies to reconfigure operations rapidly, often at higher costs and lower efficiency, at least in the short to medium term. Unemployment would likely rise, not just from direct layoffs, but from secondary effects. As businesses struggle, they reduce hiring or cut staff. This creates a ripple effect through the labor market, increasing uncertainty and reducing consumer confidence, which feeds back into lower economic activity. And this is where the psychological impact becomes critical again. When people see companies disappear and jobs vanish, behavior changes. Spending decreases, saving increases, and risk-taking declines. The economy doesn't just slow mechanically, it slows because people become more cautious. So while the financial collapse happens fast, the real economy absorbs the shock over time. But make no mistake, the impact is just as real, just as significant, and often more painful. Because unlike portfolios, daily life doesn't recover with a simple market rebound. Now we move beyond the immediate chaos and into something quieter, but far more damaging, the long-term consequences. Because economies don't just run on money and jobs, they run on innovation. And these companies aren't just participants in innovation. They are, in many ways, the engine driving it forward. Remove them, and you don't just lose products, you lose momentum. Research and development budgets shrink dramatically. Billions of dollars that once funded breakthroughs in artificial intelligence, semiconductors, and cloud infrastructure simply disappear. And innovation, unlike markets, cannot be restarted overnight with a policy decision. Think about how much of modern technological progress is concentrated in a handful of firms. These companies aren't just competing, they're setting the pace. Without them, the speed of advancement slows, not because others can't innovate, but because the scale of investment becomes significantly smaller. Startups would feel this immediately. Many depend on acquisitions, partnerships, or infrastructure provided by these giants. Without that ecosystem, funding becomes more cautious. Venture capital tightens. The pipeline of new ideas doesn't stop, but it becomes narrower, slower, and far more uncertain. Governments would also face a serious challenge. These companies contribute enormous amounts in tax revenue, both directly and indirectly. When that disappears, budgets come under pressure. Public spending on infrastructure, healthcare, and social programs may need to be adjusted, often at politically sensitive moments. At the same time, governments might attempt to fill the innovation gap. Increased public investment, incentives for new industries, regulatory shifts. But historically, government-led innovation tends to move slower than private sector competition, especially at the scale and speed these companies operate. Globally, the impact becomes even more complex. US tech dominance isn't just an economic factor, it's a geopolitical one. These companies extend influence through platforms, standards, and infrastructure used worldwide. Their disappearance would create a vacuum that other countries would quickly try to fill. China, for example, could accelerate its push to expand technological influence. European firms might attempt to scale up. New players would emerge. But replacing entrenched global ecosystems isn't simple. It takes time, coordination, and enormous capital, none of which appear instantly after a collapse. Supply chains would gradually reorganize, but not without friction. Semiconductor production, cloud infrastructure, software ecosystems, all would need to be rebuilt or redirected. During that transition, inefficiencies increase, costs rise, and global productivity takes a measurable hit. Education and workforce development would also shift. These companies currently attract and train some of the most skilled workers in the world. Without them, talent disperses, which sounds positive, but it also means fewer centralized hubs of expertise driving large-scale, coordinated innovation. Financial markets, over time, would attempt to rebalance. New leaders would emerge, sectors would rotate, and capital would find new opportunities. But this process isn't immediate. It can take years, sometimes decades, for markets to fully adjust after a structural shock of this magnitude. And during that adjustment period, uncertainty becomes the dominant theme. Investors become more cautious, risk premiums increase, and capital becomes more selective. This slows expansion across multiple industries, not just technology, creating a broader drag on economic growth. Meanwhile, consumer behavior adapts slowly. People find alternatives, new platforms emerge, and routines stabilize. But the transition period is rarely smooth. Friction in daily life, whether through higher costs or reduced efficiency, accumulates, subtly lowering overall economic productivity. over the long term, the economy would recover. It always does. New companies would rise, innovation would continue, and systems would rebuild. But the path to that recovery would not be linear, and the world on the other side would look fundamentally different. And that brings us to the final, unavoidable conclusion. When so much value, innovation, and infrastructure is concentrated in a few entities, their success becomes a strength, but also a vulnerability. Because if they fall, they don't fall alone. They take part of the system with them.